everybody, what's up? We are back with another stock analysis. Today we'll be looking at Trade Desk. So honestly, don't know a lot about the company at all. I know they have had a very large fall recently in their stock price. So that is the big thing that drove me to look into them. So we're going to get into it, go through the financials, a couple other things. So if you are interested, make sure to subscribe. I make these videos just about every day of the week. And yeah, let's get into Trade Desk. All right, so getting into Trade Desk today, they have a lot of different things: advertising, audience targeting, cloud-based ad buying platforms. So a bunch of things that I do not know about, but they seem pretty interesting. So industry metrics. One thing we're seeing is fairly decent billings growth over 2025 for the estimates, at least. This is a almost $38 billion company. No dividend, target price at $112 with a 16% long-term growth rate. Right now, we're sitting at $74 a share, so there could be some pretty solid upside there. However, if we just go into their chart here, you could see they're most likely going to be revising that estimate pretty soon, because right now they are sitting at a pretty rough situation. So last earnings report that came out, they got absolutely slaughtered, probably because revenue missed so well, actually, it really didn't even miss by that much. I'm assuming what happened here was guidance was lowered fairly significantly, but if you just zoom out and look at this drop, it is massive. They haven't seen these prices since like last year, basically a full year ago. And during that past year, they had very, very good growth. So seeing them back at this range isn't really great. They did have a pretty strong support area right about here that they have now completely smashed through. So realistically, the floor here could be almost anywhere. I would say probably $60 is a pretty good floor for this current drop. After that, I would go to $40. But I mean, if it gets to be that bad, it could be disaster for the company, if I'm being completely honest. I mean, they are looking at a massive drop over the past 2 weeks, 31% last week, and they're already down 7% this week. So overall, it does not look great. But at the same time, this could be a great buying opportunity for what is hopefully a really good company. So let's get into some financials. Starting off with their growth summary, we could see pretty strongly positive here. Sales growth looks really solid. Free cash flow even better. So overall, I would say that there is definitely some positives here, clearly. But we're going to have to get into the financials and see what they've been up to. So starting off with the income statement, I'm going to look at the quarterly view here right after I go over the years. But what we're seeing here is a lot of sales growth, a ton of sales growth, actually. They have massively expanded their sales over the past few years, basically doubling over the course of 3 to 4 years, which is really good. Net income is also consistently positive, and we're also seeing an all-time high for 2024, which is awesome. Same thing with operating income. We're seeing an all-time high. Although their net income has been a little bit shakier, their operating income has been very consistently going up, I would say, or at least much more consistently. But net income, 3 straight years of growing. And before that, it was a little bit higher, but there's probably just some other circumstances that made that happen. So it's a little bit misleading here. But overall, $400 million in net income off of $2.4 billion in sales is really solid margins. And I believe there was improvement in margins over the past year. Just based on my own brain trying to do the math here, but there was definitely some significant margin improvement over the past year, which is awesome. Next, we are looking at the total shares here, and it looks like they have been diluting fairly consistently over the past every year I see here. But one thing I will say is that it looks like they have slowed it down a lot for the past 2 years. So diluting 3 million, and then looks like just about 1 million shares from 2022 till 2024. And before that, they were doing like 10, 20 million shares plus every year. So that is definitely an improvement that I will say. But other than that, let's head into the balance sheet now and see what's going on. So first things first, we need it to actually load for us. And once it does, we'll get into it. So, okay, cash looks solid. Not a lot of debt at all, which is a very good thing. They have just under $2 billion in cash compared to about 300 million total in debt. So very good to see there. Total assets have been increasing very steadily, which again we are seeing correlate with that sales growth. So that is also really good. Hopefully that continues and they really start seeing some solid growth coming soon. Or I should say accelerated growth coming soon. They're already seeing really good growth. But other than that, let's move into the cash flows and see what else is going on. So operating cash flows look really good. A lot of growth over the past couple of years. They've seen their all-time high cash flow in just the past year. For investing activities, it looks like we have a lot of investments being purchased, which is awesome. That's usually almost always a good sign. And we're also seeing the change in stock here. So that consistent diluting has been going on. In 2023, they actually lowered their total shares, and it looks like in 2024 they're going to increase it once again, but a lot less than they have been in years prior, which is good. Um, and other than that, we're seeing all-time high free cash flow and consistent free cash flow growth for about 4 years straight, which is awesome. So overall, everything here with this company looks really good. There's really nothing negative that I've seen, so everything looks good. Gross margin is just about in line with the 5-year average. It is basically where they've always been. They've always been right around the 80% range. One thing I will say though is SG&A sales is way lower than their 5-year average, which is awesome. Net margin is also a lot higher than the average, which again, excellent. Across the board, that is a very, very good thing. And you can see that year over year growth was massive. So they nearly doubled their net margin in 1 year, which is fantastic. You really don't see that very often. So seeing that here is a very good sign. Anyway, one last thing is their debt to equity. And we can see here it's at just about 10%, which is basically nothing. That's a very low number. Nothing to be concerned about there with their debt situation. And saying that, let's move into earnings and see what we can find here. So fiscal year 2024, we don't have a metrics recap, but we do have street takeaways, which is strange. But overall, let's see if we could find some just regular things to go into. So I'm really only looking for guidance here, and we found it. So revenue at least 575 million for the first quarter of 2025. Let's see what their last few quarters have been, and we'll see how that looks. So revenue of at least 575 is lower than we've seen in the past 3 quarters. There could be a little bit of seasonality with the company. We are seeing a lot higher numbers in the December quarter than other quarters. So that does kind of make sense. Also, their first quarter seems to be a little bit lower, possibly some seasonality here. But either way, I would say that number is okay. Not fantastic, but okay. And then EBITDA of 145. So we are seeing just about in line. I would say that's actually really good. Obviously, that December quarter again is always higher for this company, but 145 would be excellent to see just based on the numbers here. So overall, that's really good. Other than that, no outlook provided for net income. Just reading through the rest of this. So overall guidance, I would say looks okay from the stuff I saw here. But other than that, we can just continue moving on to the street takeaways and see what they're doing, or I should say what they've said there. So first off, there is a couple different things here. I'm going to zoom out a little bit. A very large overview. One thing I will say is target lowered, target lowered, target lowered, and target lowered. So across the board, price targets were lowered, which makes a lot of sense when you see just how much the company has fallen from this earnings report. Again, the numbers seem okay, and the guidance also seemed kind of all right, but massive fall off here. So let's see what they're saying about this. So shares are down 30%, missed expectations with revenue falling short, estimate and EBITDA coming in below expected, EPS beat estimates slightly. Guidance for quarter one was light. So that's also what I was saying. The revenue didn't seem great, and that is coming in below FactSet's estimates as well. EBITDA came in also below. Management noted outpaced every segment of digital advertising, delivering decent revenue, accelerated growth, and record $12 billion of spending on their platform. So that is good. They did, what's the right word for that? They did acknowledge that they did fall short of their expectations, which again, that acknowledgement probably accelerated how much their stock went down, if I had to guess, just because it's the company saying, yeah, we didn't do good. But other than that, we took a reorganization to accelerate opportunities. So overall, I would say things are fairly positive. Um, First earnings miss in 33 quarters, not including COVID, was that's insane. So one thing I'm going to say with this, if they continue to fall, which I believe if we go to the daily view, today they are still falling. If they continue to fall this drastically, this could be a great buying opportunity because I really don't think there's not that many negatives here. Don't get me wrong, they did miss estimates significantly, but at the same time, look at these price targets. $145, 130, 115, 130. We're at $74 right now. So seeing these price targets and the market reaction to this earnings report, I'm going to say that this is a massive oversold situation. And let's actually look at the competitors now and see what we're going with in terms of valuations. Also, one other thing, if you do want to read through the rest of this, please feel free to pause here. I'll leave it here for a second if you do want to read through everything. I'm going to get into the valuation now, though. So let's do that now. So a lot of different companies to compare to here, and it does look like they are overvalued or undervalued compared to them. So let's put the numbers in here. So we have 80.77, and actually it does look like there's an outlier here, so I am going to get rid of that company just because it seems like they're bringing up the average a lot. So 54.4 and 58.57. Let's put that in here. 8.57. And that gives a current downside. Okay, so this has their PE currently at 95.95. So saying that, based on their EPS, I don't think this is the most correct. If we look here, it shows their PE at 43, which is still honestly a very high PE ratio. All of these companies here actually have very high PE ratios. But this is currently giving me an estimate of 95, which is really high. Let's see if I can find their most recent here, and maybe we can use that instead, because I do think this company is definitely undervalued now. So most recent quarter was, or I should say most recent year, they were at 1.66 with a PE of 70. So let's put in that 1.66 number and see what it does here, which should put them into undervalued range. And yes, it does. Okay, so I would go with this more than the last number I had, only because sometimes the Google Finance has a very strange way of finding their EPS. I'm not really sure exactly how they do it. It could be quarterly, but I usually go based on years. And usually it comes up with a pretty solid number, but sometimes it's a little weird. But overall, this shows a current valuation of $93 a share with a 25% upside. I would say this holds up fairly well. And one other thing I'm going to do is look at their named competitors. So that was just the software sector as a whole, which works out pretty well, I would say. And actually, it looks like it's just about the same here, 54.4 and 58.57, which is the exact same thing I have here. So named competitors and the software thing basically have the exact same thing here. So I won't change too much, or actually I won't change anything. But overall, I would say undervalued is definitely the big part of the conversation now. I think it's very clear that the company has probably been oversold. I mean, just you don't see candles like this on any chart usually unless there is an oversold situation. So overall, financials are still good. They're still doing a fairly decent job with their performance. I would say that this is in a extremely oversold situation. I mean, just look at, I usually don't talk about my indicators at all, but this is a momentum index down here, and this is the lowest I have ever really seen, especially for this company. This is the lowest they have ever seen on this momentum indicator. I think this is most likely an excellent time to look into this company more. Make sure to do your research, of course. And that is all I have for the trade desk today. So make sure to subscribe if you haven't. Thanks so much for watching. Leave a comment, any other companies you want me to review. And yeah, that's it. See you next time.